Hi, good evening, everybody. This is Sahil Kapoor. I head the products team at DSP, and I'm also the market strategist. I'm joined by Dhaval Gada. Dhaval is my long-standing colleague. We've been together for a very long time, and Dhaval manages our BFSI sector in the investment team. This call today is regarding the banking crisis going on, and the structure of the call is I will give you a brief snapshot of what we think about the crisis. Dhaval will step in and talk about the difference between Indian and US regulatory structure for banks, and also his sense on what has happened with CS and other banks. And going forward, what does he expect to happen in the Indian banking scenario? And then we look at a few indicators which can tell us whether there is a contagion in the market or not, and what to make sense of this crisis. So to roughly tell you in terms of what are the key indicators and what to watch. First, I will take you back to a very specific issue, and I'll share my screen here. And I hope it's visible, and all of you can see my screen. So I want to start with a very particular case, which is the savings and loan crisis, which happened in US in 1980. And this is a very peculiar problem, and I'll talk about it why. First, let's see what was SNL, which is called Savings and Loan Crisis. So there were certain entities in US called thrifts. They used to lend money and also accept deposits. And they were long-standing institutions. There was a wave of bankruptcies in SLN in 1980s, and I'll talk about them why. So particularly these institutions also exercise something which is called borrowing short and lending long, right? They borrowed short-term capital and lent long-term. And because of that ALM mismatch, there was a $600 billion size industry which got into trouble. In 1980, there were 4,500 savings and loan institutions in US, and about 1,400 failed over a 9-year period. And why did this happen? So these SLN were permitted to make fixed rate mortgage loans for up to 30 years. That was their structure. And they were funded by mom and pop modest passbook deposits, which is, people depositing money in these institutions, generally middle class Americans and small businesses. And it worked very, very well until rates were low and volatility was less, particularly in the aftermath of World War and up until 1980s. And then these global commodity shock, oil shocks were delivered, and inflation skyrocketed in US. And at that time, interest rates were raised significantly. Volcker raised rates to all-time high levels during that period. And that brought a huge amount of problem to savings and loan institutions. But there was a previous past to these institutions. In 1966, a regulation called Regulation Q was applied to SLN institutions. What that regulation did is that it capped the rate of interest that these institutions could pay to their savers. And that rate was capped at 5.5%. For example, if you had an account in one of these institutions, you will only receive 5.5% max rate. It will not go beyond that. And also there were some usury laws in US in certain states, and they restricted the interest rate that savings and loan institutions could charge to their borrowers. So if these institutions made a 30-year fixed mortgage loan, they could only charge between 6 to 8% peak rates in different states in the United States. So up until when the interest rates were steady, these institutions had no problem. It was a great, story. They lent a lot of money. But when interest rates went up, these institutions were caught off guard, right? So for example, in 1980s, when peak rates were reached, the prime lending rate in US was at 21%. So what happened at that time was these institutions were only paying 5.5%. Many unregulated money market funds started paying double or even triple of the interest that these guys were paying. And that started a run on these institutions. Depositors called back their deposits. And that is the time that they faced huge amount of redemption pressures, and ALM mismatch happened. And to tackle these issues is something which I want to talk about. What did the regulators do? First thing is that they repealed the Regulation Q, which allowed them to pay higher interest rates to saver in expectation that savers will stay. And it it increased the problem significantly, because now these SLN were paying higher interest rates to saver, but they were still charging lower. and their investments or their bond book, so to speak, or where they had parked their assets, they were still giving them much lower interest rates because their durations and the profile of the book was still at 7%, right? And this caused these institutions to fail. They were governed at that time by an agency called FSLIC, which is called the Federal Savings and Loan Insurance Corporation, and it insured certain deposits. But the overall capital that that institution had was only $6 billion. Okay, and the size of the industry was $600 billion. Now, and also, if you look at that time, what was the thought process of the regulators? And there is a very nice paper called "The Savings and Loan Crisis and Its Relationship to Banking." You can read it, and it has a large number of details. And if you read what the regulators at that time were thinking, I want to highlight a few paragraphs. The primary problem of lack of real FSLIC resources available to close insolvent SLN. In addition, many government officials believe that insolvencies were only on paper, and they were caused by unprecedented interest rate levels that would soon be corrected. And these lines does sound like a lot of arguments that we hear today. And we'll talk about these numbers and why I'm telling you. And then if you read this, the Assistant Secretary of Treasury, Roger Mille, testified on behalf of SLN. And what did he say is very, very important. He said that because their income, he said that these thrifts, which they were called at that time, did not have a serious problem because their income came in the form of mortgage payments, whereas most of their expenses were in the form of interest credited to savings account but withdrawn. He stated, I wish my income was in cash and my expense in the form of bookkeeping entries. So essentially, many officials at that time thought that this is a crisis only on paper because these institutions held securities which were valuable, and they said that they also received a lot of mortgage payments in the form of EMIs, and they paid interest to savers, which was seldom taken out of these thrifts. And they thought that therefore this is only on paper and they could change regulation and save these institutions. And when you read this paper, you will come to know, and many other books, that they were opposed to closing these institutions or merging them. And therefore, it took about 9 years for this crisis to play out. And a number of institutions failed. Credit growth in US slowed, and in general, economy also slowed to some extent. Not only because of this crisis, there were many other reasons, but this was a contributory factor. Now, why am I telling you all these numbers? If you look at the current crisis, there are certain number of parallels. The overall small banks in US, they appear to be of similar nature, where there is an ALM mismatch. There is a call for deposits. All the savers who have put deposits in small banks in US are, in a sense, they have a put option. They can any day call their money from banks, and that is causing a ALM mismatch in many of these banks. Dhaval will, take this in detail. But two very, very important points. The regulators now, when they have acted, they have done something very different from what has happened in, let's say, 1980s, which I think has some parallels to the current crisis. At that point, regulators delayed. They changed regulations rather than supporting the SLN and the banking system. In this instance, I think the biggest change which has occurred is that FDIC, which is the present day FSLIC equivalent, has stepped in along with Federal Reserve and US Treasury, which is very different from the handling of crisis which happened in 1980, or even what happened in 2008 global financial crisis. In both these crises, the responses were delayed and insufficient. And we have seen that in recent memory, in the last 15 years, most central banks have acted and given stimulus or probably support which is much larger than required. And even in the current crisis, although I won't say that there is enough support which has already been given, but I think the measures are timely and they are broad-based. So the difference between these two crises is the management of the crisis. And this time we believe that the management is more harsher, and it is probably more front-loaded than being back-loaded. And we'll come to what the crisis in. But let's look at a few numbers on in case of US particularly, and then we'll also talk about Eurozone. The size of US GDP is now 26 trillion. The US debt market is 53 trillion, with treasury outstanding of about $23 trillion. Mortgage-backed securities at 12, corporate bonds at 10 trillion, and municipal debt is 4 trillion, and agency plus ABS and MMs at middle market funds at 3 trillion. So all these put together are at $53 trillion of debt market. When you look at the size of the banking sector in US is at $23 trillion. Large US banks, 13 trillion. Small US banks are at 6 trillion. And this is where the problem has started. And these 6 trillion asset is supported by about $508 billion of large time deposits. There are other deposits also of about 4.5 trillion. But this is the biggest chunk of the problem, large time deposits, where we are seeing a lot of redemption pressure or depositors calling back their money. So if you were to put a size on what is the size of this crisis, so to speak, when you look at these numbers, you could put it anywhere between 500 billion to $1 trillion in terms of redemption pressure. So I think this is the size. For now, the Federal Reserve and FDIC and US Treasury has put out a program where institutions can borrow up to $2.2 trillion. So first thing is that for now, the regulators are providing liquidity. Secondly, they are trying to force a lot of M&A activity so that weaker institutions can get gelled with stronger institutions. And third, I want to talk about the origination of crisis and then possibly give it to Dhaval. If you look at some of these regional banks, their insured deposits are small as a proportion. For example, SVB had 92% uninsured deposits. That's deposits were very, very lumpy and concentrated. For larger banks, this is not the case. For example, in case of a JP Morgan, it has many small deposits which are below $250,000, and therefore the insured deposits are very large in number. For example, another First Republic Bank, which we are hearing about for the last many days, if you look at the overall deposit base is about $190 billion. Out of that, about 119 billion, 120, roughly $119 billion are uninsured. Right. So this is the reason why these smaller banks have very lumpy deposits from local community businesses and local mom and shop businesses, mom and pop businesses, and therefore their deposit base is very lumpy. And when it gets called, their asset side becomes a big issue, right? And because these deposits are called back, and on their investment side, what they have done is they have invested this money in long-term paper, some of these banks, specifically SVB. To talk about it more and look at what is the difference between US and India, and then we'll come to why India is different in terms of its structure and what is our outlook on India. I will now invite Dhaval. He will take us through more details on the structure and the industry. Dhaval, over to you.
Yeah, thanks, Sahil. So, like Sahil mentioned, you can share the screen. Like Sahil mentioned, basically the idea was to first, give perspective around the capital requirement in US and India, and what other buffers or regulatory buffers that are there between the two, countries and the systems. So first in US, so you can see on the table on the left, it gives you perspective. Broadly, about 7% is the minimum equity capital requirement in US compared to 8% in India. And similarly, there are other instruments of capital that are available. So overall, if you run a bank in US which has, let's say, 100 rupees of assets, that would require about roughly 10.5 rupees. Similarly, in India, you require slightly higher capital of about 11.5 rupees. With equity capital being higher in India. The other part to keep in mind when you think about capital is what kind of risk that the asset that the bank is underwriting has. Typically, we've seen in some of these developed economies, the regulators have been slightly more, relaxed in the aftermath of COVID, where the risk weights that are assigned to some of these assets have been slightly more generous, and they've given time in a phased manner to come back to normalcy over next 2-3 years. Whereas in India, that's not been the case, and so our capital requirements are far more stringent, and our hence the one part of the balance sheet is far more insulated. The other part is also on the reserve requirements. So apart from the equity capital, the overall capital base that a bank has, the other thing to keep in mind is what is the reserve that the regulator is asking. So in India, for example, we have roughly 4.5% of the liabilities in form of reserve with the central bank, which is called CRR. Similarly, we also have 18% of statutory liquidity ratio, SLR, which is basically investing in AAA assets, GSECs, predominantly in GSEC. So that is the other cushion that you have on the asset side. So against the liabilities that you have roughly 22.5% of that being in essentially zero risk or very minimal risk assets. That is the bare minimum that the regulator requires. Similarly, in US, until 2020, this number was 10%. They do not have any CLR. They have concept of equivalent concept of SLR. So that was 10% until 2020. Post 2020, that has been removed for the time being. So that is as far as a reserve requirement is concerned between the two markets. So again, the balance sheet is far more insulated from a liquidity standpoint, and we'll see that I've given a comparison here, which shows how the capital structure and the requirements are between the two banks. So I've taken Credit Suisse and SBI. So like you see, I mean, both the banks are so Credit Suisse is obviously globally systematically important institution. SBI is domestically systematically important institution. So you can see that despite that, SBI has a higher capital requirement compared to Credit Suisse in terms of the equity base and the overall capital base. And in terms of actuals as well, one thing to keep in mind is while the CET1 ratio of Credit Suisse was 14%, but you'll see in the next slide how despite this, they went down and needed a bailout. So here, what I've explained basically is the balance sheet structure, of the three banks. I've taken HDFC Bank as a representation for India, Credit Suisse and SVB. So if you see, so there are two or three important points in this slide. First is you can see that the equity composition of a Indian bank, and this will be true for most Indian banks. The equity percentage in the overall balance sheet is far high. So in case of HDFC Bank, this is about 12% of the overall balance sheet. In other cases, it is much lower. And this is, like I said, it is true for many of the other Indian banks. The other point to keep in mind is what kind of composition that you have on the liability and the asset side. So first on the liability, you can see the uniqueness of an Indian bank balance sheet. A large part of the liability is deposits. That is not the case. Like for example, in Credit Suisse, that is not the case. And even in case of SVB, while they had a larger share of deposits, like Sahil mentioned earlier, it was quite chunky with bulk or I think some number less than 40,000 depositors accounted for more than 85% of the balance deposit base. So that is as far as the liability part of the balance sheet is concerned. Coming to the asset part of the balance sheet, like you see, I mean, our Indian bank's balance sheet is far more loan oriented, credit oriented. Whereas if you take, for example, an SVB, it is more investment book oriented balance sheet structure. And in case of Credit Suisse, for example, it was more investments, liquid assets, and less of loans. Partly the design of the balance sheet was very different in all the three cases. So the point to draw from this slide, if you were to sort of conclude and draw the common point here, one, we have higher equity base, so more skin in the game from the balance sheet standpoint. Second, our balance sheets are far more funded from deposits, which are relatively more granular. We have a concept of low-cost deposits in form of CASA, which is not prominent in many of the developed markets. So it's far more granular. And on the asset side, unlike illiquid investments or sort of corporate debt, we have it in form of loans, which is very different. And like I mentioned earlier, we have far higher reserve requirements in terms of CRR and SLR. So our balance sheet structure is very different compared to many of the other banks, and far more conservative compared to many banks elsewhere. So that's the key takeaway. If you go to the next slide, I just wanted to give and bring the fundamentals of banking. So many times we assume things are so we look at asset quality, we look at portfolio of the asset, but this is a classic case of trust, which is the core of lending business, core of banking business. So you can see, I mean, I've given a 10-year history of Credit Suisse and just simplistically looked at, what this bank has gone in terms of journey. So actually, the bank saw loss of trust for fairly, I think for the last 15 years, they've gone through transition. But in the last, even before the crisis, which happened a few weeks back, they did see the last year, if you see the left-hand side chart, they did see almost 35-40% drop in the balance sheet size in last year itself. And you can see the deposit base coming down from $393 billion, Swiss franc, to 233 Swiss franc last year itself, well before the crisis. And so basically they lost trust from the market, much ahead of the crisis. And you can see the profitability profile on the right hand side. They had massive losses last year for a fairly long period of time. Their profitability, so on a asset base of 700-800 billion Swiss franc, their profits were almost negligible to that extent. And so there was loss of trust. There is the crisis actually started last year. And the last point, which I wanted to sort of link to what Sahil mentioned earlier, why we are, sort of coming out, is basically, if you see in case of Credit Suisse, or you take parallel in India in form of Yes Bank, what we saw in March 2020, what we see is that the balance sheet size shrinks much ahead of time, even before the crisis unfolds, which basically makes the problem far smaller compared to where it is earlier. So regulators have found this, or system has found a template to identify the problem, fix it, make it smaller, and then move on. So that's the other key point from this episode. Coming to the last part, which is around how markets react. So I just took the price performance of the financial sector and looked at what's happened. So if you look at the bottom chart, which is how financials have performed compared to the broader market, respective broader market, you see that some of the EMs like China, Brazil, Indonesia, India, basically the financial portfolio YTD has performed broadly in line with what the market has done. Despite seeing correction, they're just broadly in line with the market. Whereas you see US or world, MSCI World or US, financials have significantly underperformed, which is reflective of what's happening in those respective markets and the financial system. So the point from this chart is, I think overall we are relatively less impacted and more sentimentally impacted rather than the system getting this contagion in the system. That's my broad take from this. Sahil, back to you.
Thank you, Dhaval. That was very insightful. And now we'll talk about certain market indicators and what to look forward to a certain where we are. I think that is one of the most important thing, and I'll try to answer whether there is a contagion or not. But be rest assured that I do not know. But I will try to look at what are the indicators that can guide on what to look forward to. You can actually use a questions tab on your screen. You can ask us questions. Once we are done with our presentation, we'll take your questions and we'll try to answer them. So please put in your questions as and when you have them in mind, so that we can answer them. So let's look at certain measures of risk. This is what is called FRA-OIS spread. Now, FRA-OIS spread is something which tells you that what is the interbank market thinking? Is it panicking over what's happening otherwise, right? So this is FRA-OIS spread, and you can see that in COVID times it spiked high, and it has again spiked higher, although it peaked at about 60, and right now it's at about 40. It fell to about 32 day before yesterday. So it has peaked or probably not peaked, I do not know. But I think the spike that it made, the second reaction has been lower. So in US, in broader interbank market, the stress is high, but it is not as high as the crisis period. And let me take you to, let's say, the COVID period when the stress was very different. This is the COVID period, and this is like a bigger chart, bigger time series data. And if you look at June 2008 and the aftermath, October 2008, when the global financial crisis was raging on, this spread was at about 185, 189 bips. And this is where we are right now. So this is one of the most important indicators of gauging why interbank stress is high or low. And if it is high, it tells you that there is a very large risk of contagion that the market is discounting. Second and very important data to track, which I think is going to come out today and probably is going to be market moving for the next few weeks. So if you go to a website and go to the Federal Reserve website, there is a schedule, United States H8 schedule, which gives you asset and liability of commercial banks in US. And as you can see, the data for 24th March is not out. It will be out at 4:15 p.m. And if you go to the 17th data release, which gives you data until I think 8th of March. This is the data updated till that day. This is the release date of data. So it is one week dated. So it will. So the data that will be released today will be of 15th March, which will be much more updated. And what do we want to watch in that data? So if you keep tracking this data, if you scroll down, there is a screen which will tell you what is the share of asset and liability of large domestically chartered commercial banks for the likes of BofA and JP Morgan. We are not interested in that. We want to go and see what is the asset and liability of small domestically chartered banks. And we want to go and see what's happening with their deposits. So if you look at this segment, deposits, it's at 508 billion of large time deposits and other deposits at about $5 trillion. We want to see how fast or slow are these numbers moving, right? Because we know the data for money market funds, that data is available live, and we have seen a 200 to 300 billion dollar move in money market funds over the last few weeks, and that I think is probably going to reflect in banking deposits data, and that is something which the market is very critical about. It wants to look at that data, how far that data is moving. Retail money market funds in US have about $1.7 trillion in assets. So it's a very large market. And that I think is something that we need to track. And that data is also available on US St. Louis Fed website, and many other websites. You can track that data. That is again something that we want to track. The conclusion from this spread is that market is nervous, but it's not as nervous as it has been in many other previous crises. Can this ratio move higher? It can. It's a concurrent ratio. It does not have predictive power. But as of now, it shows that the crisis is still contained. and the larger interbank market in US is not under tremendous stress right now. Second is the again, something which is very important is the financial conditions in US. So if you look at, I have taken three indicators here. One is the financial conditions in US, which is the blue line. One is City India Financial Condition Index, which is the red line. And then there is green line, which is for Eurozone. And if you look at all the three lines here, Eurozone financial conditions have been deteriorating for the full year since 2023 started, or even before that. US financial conditions have significantly tightened over the last few days, but they are far away from COVID or GFC or European debt crisis, although European conditions are extremely tight, right? And if you look at India, which is something which is happening, probably it doesn't happen again and again. In all previous crises, we have had our own crisis like 2013-14, and we've also participated in all global crises. But in the current crisis, our financial conditions have not tightened as of today. They continue to remain steady. We haven't seen any significant deterioration. Can these numbers deteriorate in the future? They can. But for now, it does appear that we are doing much better than the globe. Second, US financial conditions have deteriorated, but there are still no signs of widespread contagion. If it appears, it will appear here. So we need to track this data over the next few weeks to ascertain whether this is happening or not. Also, one more point here that financial conditions in US have tightened and possibly created an additional 50 to 75 basis points of rate hike-like impact. So it has done what Fed wanted to do to a very large extent, and that also, calls into question for Fed to hike again after hiking 25 basis points recently. So it reduces the probability of more rates in US because these financial conditions have tightened. Conclusion from this chart is European sector does appear to be in more trouble versus the others. But when you look at the top 12 European significantly important, systemically important financial institutions, none of them have very significantly deteriorated books. They have fixed their books over the last 5 years, and they don't have credit issues per se. So the fear that there could be bank run on other banks right now appears to be low. But again, there will be a lot of price volatility, specifically in banking stocks. And here I want to pinpoint a very, very specific issue. Over the last 2 weeks, a lot of participants have looked at stock price of US regional banks and certain European banks and ascertained that this is a sign of contagion because many of these banks have fallen 50-80%. But as Dhaval explained, if you go back to Dhaval's slide on how the balance sheets are structured, if you look at SVB and other banks, and if you look at their asset side, which is loans and investments, and just for what is happening right now, if you just consider that deposits for these institutions are flying away for regional banks. A lot of depositors feel that they are better off parking money at, let's say, larger banks or some other stronger banks or at money market funds. And that will lead to what will happen is, the books that these banks have, their book value will fall drastically over time. Their businesses will get squeezed out. And I think that is what the markets are pricing in. These stock prices are reflecting deteriorating business conditions for these counters. And for the weaker banks, which I think are about 6 to 8 in US on the regional scale, it also represents some solvency issues. But at the broader level, it does represent more of businesses taking a hit rather than stock price reflecting insolvency issues. So we have to be very careful in looking at these data points and ascertaining the right indications that they give. The next chart is what we have an internal indicator called VMF, which is volatility indicator, and it has spiked higher. Last time when it spiked higher was this instance when Nifty was trading at 15,000 or so, and we highlighted it. A previous larger instance was during COVID. An earlier instance we have seen during global financial crisis and during the dot-com bubble. Can this indicator move higher? It can. There is no stopping it. But when you look at the breakup of this indicator, the volatility coming from VIX or the equity market is much lower, and volatility coming from FX market is still lower. but the volatility from the bond market or the move index is very, very high. And that is what is causing this indicator to move higher. Historically, we've seen that these indicators rather peak very, very quickly. And once they set in their high, it's very, very tough for them to take out that high, which means that the problems appear to have peaked only in hindsight. You can't know it in real time. And this indicator indeed make a peak on 13th March, and since then it has been trending lower. The next few readings have been lower, but we are still, cognizant of the fact that it can move higher. But again, the conclusion is that one more risk indicator has moved down one notch in terms of showing that the probability of contagion is lesser when you compare it to history. The next is what is the impact on the Indian market, and then probably we'll take questions because we've already utilized our time limit. When you look at this slide, it tells you what are the spreads of Indian corporate bonds, and how they are moving. So if you see in this rate hiking cycle, Indian corporate bond spreads haven't really moved higher. They have moved higher, but if you look at the past cycles, like an IL&FS crisis or the previous 13-14 cycle or the global financial crisis, these spreads were very, very high. And right now, the both AA and AAA paper are trading below their long-term average spreads, which means that even with the new troubles that we've seen in the last 2 weeks, Indian bond markets are still stable in comparison to what's happening elsewhere. And which tells you that probably, although India is not insulated, so to speak, but it is able to weather the storm much better than many other countries and many other sectors. So in conclusion, we feel that the concurrent measures of risk, they aren't pointing to a contagion yet, which is something that we need to highlight. These indicators don't have predictive power, as I said, but we need to track them to gauge the market. As of now, they don't tell you that we are in a contagion environment. There is likely going to be more M&A activity because, as I explained, the SLN crisis, something similar is playing out, but the actions from regulators is much more strong this time, and therefore we can avoid harsher outcomes because of these actions. Solutions we feel range from TARP, which is Troubled Asset Relief Program, what Fed introduced in 2008, and there is also a possibility of guaranteeing all deposits of small banks in US, which I think is a very, very strong measure. It may not be even required, but they can do it, which will bring back confidence in the system altogether. Indian markets are not insulated from global flows, but local measures of risk that we watch, they are still calm, and we feel that India could weather this storm, whatever the storm is doing right now. In US and Eurozone, we feel growth is a bigger worry and bigger reason to worry right now, because growth is slowing at a faster clip in both these countries, and that could be reasons for regulator to be more concerned going ahead. And so I will stop here, and I'm sure there'll be a lot of questions, and we'll try to answer all the questions that you have. And if you have any questions, you can put it in the questions tab. We'll be more than happy to answer them. I have a few questions which I will answer. There are a number of questions I've received, and I'll request you to put more and more questions, whatever you may have. First question that I have received is probably Dhaval, you would want to take a shot on that. Is from the standpoint of Indian banking, do you think that Indian banking could suffer similar runs, because we have also seen a spike in interest rates, and our losses at Indian banks should we look at this scenario in a similar way in India, what has played out in US?
I think it's unlikely that we will see such a run because of two important reasons. One, that the health of the system in terms of capital, we are about 200 to 50 basis point higher capital compared to where we were pre-COVID. The second is in terms of profitability. The banks are far more close to all-time high ROEs at a system level compared to last 20-25 years of data. So the health of the system is far stronger. And the second point is in terms of regulatory actions, like what Sahil has been alluding to, they've been far more swifter in India, and we've tackled this situation well, which is reflective in some of the charts that Sahil was alluding to. So I think overall our health is good. We've tackled this situation so far very well. And hence, I don't think we'll have a run similar to what we've seen at SVB or Credit Suisse or any other bank.
Thank you, Dhaval. The next question that we have is that can we expect more volatility in the market given this situation, or the markets have already bottomed out? I think it's a tough question to answer, but you should expect more volatility because these events do not go away in a week or 10 days time, because there is a lot more regulatory work to be done. There will be more actions from Fed and ECB put together, because once these confidence in the system is shaken, it takes time to come back. So you can expect that there will be more volatility, more news articles about different banks, about different institutions, and more M&A activity. So these articles can continue for some more time, but they will be answered by regulatory changes and actions of central banks, specifically in US and Eurozone. So to answer the question, expect more volatility, but also be mindful of when you look at your own portfolio, where you are positioned, in which asset class, and what kind of valuations do you have. So I think those are the more important parameters to look at, rather than to look at headline news flow, which I think will remain very, very volatile for the time being. The next question that we have is about the overall structure of banking in US. So the question is about what is the size of the problem, which I think I have tried to address in the beginning. But I'll also give you another important number, that overall US banking deposits are at about 17 trillion. Out of that, about 12.5 trillion is with the large US banks, right? Large US banks have got, let's say, at margins, they've got benefit of this crisis. Because the marginal deposit which will go out of smaller banks can flow to the larger US banks, because they are more stable. Their deposit bases are much more widespread. They are not very lumpy or concentrated. And secondly, because the Federal Reserve introduced the bank term funding program and has allowed banks to not mark to market their HTM books for the next 1 year, that allows larger banks to also hunt for yields and probably have more relaxed next 1 year in terms of reporting. So on both the liability and asset side, larger banks tend to benefit from this dislocation, although credit growth will be a victim of financial market instability. So at the margin, in terms of balance sheet, they may benefit, but in the short term on the P&L, they may take a hit, right? So these two will have to balance out with each other. But the size and the problem still is at the regional and smaller banks level. And I think it might not graduate to the larger banks level. The next question that we have is why global inflation is still high when both US and Europe is slowing down, and can we expect inflation to collapse or come down? So I think inflation per se, if you look at historically, whenever inflation has reached double digit or close to double digit numbers, it has taken years to come back. And if you plot the current trajectory of inflation, it might sound a little funny, but the disinflationary trajectory that we are witnessing today is one of the fastest on record. It doesn't feel like, but it is. If you look at the statistical data, after peaking at 9.1% in July, inflation in US is now at 6%, which has been knocked off by 300 basis points, which is one of the fastest 300 basis points decline in inflation in US history. And but it will take time, right? When you look at the breakup of inflation, one coming from housing will start slowing down significantly 2 months from now. Other aspect which comes from food and fuel has already started coming down very, very fast. Core services inflation has been more sticky, and it will begin to cool off from mid-year. So you can expect that by the time you reach September or so, US inflation will be down to 3.5%. barring any new surprises, right? So inflation is cooling down, numbers are cooling off, but this is a monthly data which comes very slow. It has its own lead and lag effects, and there can be even more volatility in data. So I think over time, in the next 2 quarters, inflation will be lesser of a worry for central banks than growth. And that is what the data suggests today, right? And that also tends to answer one more question: where will rates be headed? Can Fed continue to have very high interest rates and also fight a banking crisis? I think possibly the answer is no. For now, Fed has raised rates, but the actions that it is taking by providing a lot of regulatory liquidity and also by starting this BTFP program, in some sense, blunts the impact of higher interest rates, at least at the banking level, right? And interest rates are usually increased to slow down the economy. And how does that slowdown play out? It tightens financial conditions and allows lesser credit growth to happen, right? It slows down credit growth. But when you look at the actions of last 2 weeks, what it has done is it has allowed to remove a very large negative from happening. Although it has not, let's say, prodded credit growth to restart or increase, but it has removed a large negative from the financial sector. So at the margin, these actions that Fed and ECB are taking is trying to safeguard economic stability, but it is also telling you that continuously hiking interest rates may not be the policy going ahead. So we need to be more vigilant and watch what central banks are saying going ahead. But I think this is what historical parallel tells us. The next question is a little bit about sectors and specifically about NBFCs, Dhaval, domestically. And 5 years ago, we saw a similar crisis or maybe a different crisis play out in India for NBFCs. Do you think that NBFCs are now in better shape after getting winded up over the last 5 years? And is the sector better placed to play for the next 3 to 5 years?
Yeah, so yes, you're right. So basically, we've seen consolidation in the NBFC space over the last 5 years. So our data suggests that we've seen about a 10% growth compared to private sector banks, and overall system growing slightly ahead of that number. So there has been consolidation. Their market shares have come down a bit versus the growth trajectory which was seen until IL&FS. So yes, there is consolidation in terms of how they're positioned for the next few years. So I think overall they are well capitalized. The balance sheets are far more resilient with the level of liquidity that they carried pre-IL&FS versus where they are today. That percentage has gone up. So there is some learning that has happened from the IL&FS crisis, and overall, like I mentioned, system as a whole is seeing record profitability. So that is also helping growth and lending in future. So I think overall very well placed for next few years at least. And just one last thing, composition of assets that they are deploying. 5 years ago, real estate lending, infra lending was a big part of the overall story for NBFCs. That bit has completely slowed down, and it's more granular retail credit that is the driver incrementally. So yeah, so that's the other bit. So overall, quite constructive.
Thank you. The next question is, when can we see FI flows getting back to Indian markets, and what are the data points that they watch? So usually, I think FI flows are a lot more dependent on credit growth, and also large part of FI flows come from passive funds. And these passive funds are bucketed as, let's say, emerging market funds. And if emerging markets are doing well, you will see that India will get its own fair share of flows. And for the last 1.5 years, we've seen most emerging markets struggle, and emerging market net flows from FI have been fairly negative. And secondly, when these flows improved, India was trading at almost 90% premium to other emerging market peers, which we have highlighted in the past. And both these aspects has made sure that FIs have been reluctant to put money in India. But when you look at the current framework, current crisis that we've seen, we haven't seen very large outflows in the last 20, 30 days. From India, they have been fairly small. Secondly, I think how and when will they return? Two things, with steady growth for earnings in India, that I think is the best background. And secondly, more stability globally will cause them to look for risk assets, or you could call that a risk on rally. That usually helps FI flows come back to emerging markets. And when they do, India has a much larger weight in EM basket today. So prior to COVID, we were at 8 to 9%. Now we are at 15%. So when flows do return, which I think will happen this year, India will get a larger share in terms of flows, and that is how it will play out. One next question is a little unrelated, but it is about what is the outlook on gold? And I think it becomes very important in the current environment because gold has performed really well over the last few weeks. And as you can see that there has been a strong rally. Gold futures have been touching $2,000 for after a very, very long time. And our outlook is that all the conditions which favor a gold rally are already present, and they've been present for a while. So, relatively higher inflation versus pre-COVID levels. A revival in demand for gold jewelry has already been there in the cards. Record purchases by central banks across the world. They purchased about 1,137 tons of gold last year, a record in itself, a double of what they did the previous year. And another important factor which has now come and favored gold is a decline in the dollar index. So dollar was fairly strong. It rallied 25% it started in 21 and the rally ended in 22. So for about 18 months, dollar strengthened by 25%. And that was the phase when gold prices struggled a lot. And now after the recent correction in dollar, which I think was the only checklist item in a gold bull market rally, which was missing, now which has got fulfilled. And second important point, gold is a very reflexive asset. A lot of investment demand chases gold when gold enters the bull market, and we believe that that phase could occur if gold breaks out to a lifetime high, which is above $2,100. If that were to happen, I think gold rally could actually materialize into a strong bull market. And can that happen? I think there is a good possibility of that happening in 23, largely because we see a weaker dollar playing out ahead. So that is the outlook on gold, and that is, I think, going to be an important asset for the next few quarters. The next question is about, again, about the European banking system. And the question is that, do we believe that more such CS-like episode can happen in Europe? Are there any specific weaker banks that we should look at? So I think, although from a investing perspective, I think we have limited options to look at in terms of what to invest in Eurozone. But from a tracking perspective, two numbers I will tell you. One is that if you look at stock 600 bank index, which is a sub-index in Eurozone, it is trading at valuations which are, I think, one of the lowest outside of COVID lows that we saw, right? So valuations in US banking sector are extremely low. They are at cyclical low levels. If you look at that, index, I think the index is trading at 0.8 times price to book value on an overall basis, which is, and I think during the global financial crisis, the lows were at 0.6, and during COVID, the lows were at 0.8. So we are getting close to the COVID lows in terms of where European banks are trading. Plus also the regulator has been very stringent over the last 5 years in telling many of the risky banks to reduce their balance sheets and reduce their global linkages and derivative books. And probably that could be a helpful factor in resolving some of these banks. From which banks to look forward to, we don't have a specific name list to look at. I think the top 12 systematically important banks, that is where your focus should be if you want to track the European banking space. So I think these are the list of questions that I have until now, which we have already answered. Is there any specific other comment, Dhaval, from your side you want to mention?
No, Sahil, I think we've covered So nothing incremental.
Sure. Thank you. So I think this is it from my end, and this is it from Dhaval and me overall. Just to conclude and put things in perspective, we believe that the overall banking contagion or crisis is still fluid. Although most measures of risk that we track, they still don't indicate a blown crisis, and it might actually reduce in degree as we go ahead, specifically dependent on how central banks behave. But for now, those measures of risk are contained. Secondly, there will be continued headlines and volatility because of these actions, because historically they don't go away in a day or two, and sometimes they actually roll over and become blown crises. So we have to be very careful in assessing the situation as we go ahead. And thirdly, India remains relatively calm for now. Most of our indicators that we track, they continue to remain calm. And there is a reason for it, which Dhaval explained, that there is a difference in structure, there is a difference in the business model adopted by Indian banks, and there is a regulatory structure which is helping how banks shape up in India. And on market outlook, we have explained that things could remain volatile, but from a valuations perspective, we have become closer to average or below average valuations on the broader market, and specifically on the BFSI sector. I think valuations have become quite attractive in India. I think this is one of the only sectors, or maybe another. There are only 2 or 3 sectors in India which are trading below their long-term average valuations and below pre-COVID valuations. So with this, we'll end here, and we are happy to hear for any more questions that you have. You can email it to us. We'll be happy to answer them. Thank you for your time, and we look forward to talk to you again. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.